I'm Matthew Previtt. I'm a CPA here in Massachusetts. Since 1990, my firm has represented taxpayers before the IRS, the Mass Department of Revenue, and other state tax agencies. We are a small tax resolution firm that offers very personal service. I'd like to talk now about enforced collection action. Enforced collection action is when the IRS pursues your assets, essentially. They either levy your bank account or your paycheck or some financial account, or they physically seize your car or your house. Enforced collection action basically starts after the tax is assessed and after you wait a certain period of time without responding to the IRS's letters. They eventually issue a notice of intent to levy. If you get a notice of intent to levy in the mail that says notice of intent to levy and you're right to a hearing, call us immediately. That notice gives you 30 days to file an appeal, a collection due process appeal, and that can basically stop collection action and send the case to the appeals division. Basically, it buys you anywhere from 2 to 5 months, which gives you extra time to essentially deal with the problem. Once the IRS has issued a notice of intent to levy, and once the time for appeal has passed, they can basically hit your bank accounts, your paycheck, any type of financial account, and so forth. They tend not to hit physical assets until a lot longer after this period of time. The first thing they typically do is bank accounts and your paycheck. If you have enforced collection action, there's a couple of different ways to deal with enforced collection action. One is when you get an assessment on the books and you start getting notices from the IRS saying you owe us money, contact us. The best thing to do is contact them. Oftentimes if you call them early, and there's 3 stages in the collection cycle. Notice stage, after you file a return it gets assessed, you get 4 notices. Then there's ACS, automated collection. That's where the levy action can start, and then a local field office where you can get a revenue officer show up at your house. Essentially, if you're in notice stage, you can call up and request the hold on collection for anywhere from 30 to 45 days, sometimes even 60 days. And what they will do is they'll slow down that notice stage, that's 4 notices over 4 months, and they'll add another month to 2 months time. So they'll stop the letters from coming out. Typically what you can do is when the first hold on collection is ready to expire, you call up and get a second hold. So they'll give you up to 2 holds on collection, which can total anywhere from 60 to 90 days. And so instead of having 4 months till you get to the notice of intent to levy, you now have anywhere from 7, maybe 8 months, or 6 or 7 months. So that's very important. The other thing you can do is filing a taxpayer assistance order. If essentially you have just enough money to pay the basics, food, clothing, shelter, your car payment, gas for your car to get to work, and you have nothing left over. If you're on, the fence where you have so little money, you're about to either be kicked out of your apartment and evicted or have your power shut off, essentially you can file a taxpayer assistance order, and the taxpayer advocate service will get involved, and they'll make a determination. And if these levy actions are putting you in a severe hardship, the type of hardship where your power would be shut off or you'd be evicted from your apartment, they can step in and override the collection division and essentially stop collection action for a period of time. Another way to deal with collection action is to file a collection appeal. Let's say you get that final notice of intent to levy, 30 days goes by, you don't file an appeal, and now you're at a point where the IRS could levy your bank account. By filing a collection appeal with the IRS, you can essentially get the case to the appeals division. So for instance, let's say they levy your paycheck. You could file a collection appeal and take it to appeals to determine whether or not that levy is appropriate and possibly give you more time to deal with the problem. The collection due process, I mentioned that just a little while ago, that is a pre-levy action. So if you get a notice of intent to levy, gives you 30 days to file an appeal to stop collection action from happening. You want to do that because it's easier to deal with levies before they happen, when you get a notice of intent to levy, than after you blow the 30-day appeal deadline. The other way you can deal with enforced collection action is either getting an installment agreement set up. So if in fact you have a levy on your paycheck, and let's say you owe $20,000 and we get you set up on an installment agreement for like $400 a month, the IRS will release the levy on your wages once you implement a solution. So if you get on an installment agreement, or if you file an offer in compromise, when you file the offer in compromise and they have all the paperwork and they get it and it's processable, they will put a freeze code on the computer and stop collection action. They'll release the levy. If you file bankruptcy, which in rare cases sometimes is used, they have to stop collection action. The other possibility is the collection statute. I've had clients where if the 10-year collection statute expires, once it expires, the IRS zeroes out those taxes on their computer system. If for some reason you still have a levy attached and your employer is still sending money to the IRS, you can then contact the IRS. We can get you a release of levy to get to your employer to stop the levies from continuing. The other possibility is that, let's say you neglected to file. And so in cases where you don't file, after a certain amount of time, maybe 2-3 years, the IRS will say, hey, we don't have a return. They'll send you notices, and at some point, if you ignore them long enough, they will actually file what they call a substitute for return. And an SFR, or substitute for return, is where the government comes up with their own assessment for you, and they're going to base it upon whatever W-2s and 1099s they have, and they're not typically going to give you all the deductions that you're entitled to. So the assessments tend to be much higher than it normally would be. Once the IRS does an SFR, a substitute return, they can pursue collection. One way to stop that, file your original returns and get the tax reduced or sometimes eliminated. And if you do that and show the IRS, hey, we really don't owe $20,000, we are due a $1,000 refund, then once you get rid of the assessment, essentially you resolve the problem, you can get the levy release. Please give us a call to answer any of your questions, and if you'd like to set up a free consultation, you'll get to meet with me or talk with me over the phone, whichever you prefer, and we'll go over your situation, discuss your problem, what options are available to you, and give you some information to think about in making your choice for a tax firm. Call us at the number above.